Looking to supercharge your portfolio with serious growth? Today, we're comparing two of the biggest names in the world of ETFs, QQQ and VUG. Together, they manage over $400 billion in assets and hold some of the fastest-growing companies like Apple, Microsoft, and Amazon. But which one should you invest in for the best long-term gains? Stay tuned, because by the end of this video, we'll break down the key differences, performance, top holdings, risk levels, and help you decide which one is the better fit for your investment goals. Whether you're looking for tech-focused growth or a more diversified approach, we've got you covered. Let's dive in. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Growth investing is all about capturing the potential of companies that are expanding fast and driving innovation. And when it comes to ETFs, QQQ and VUG are two of the biggest players in the game. Both are designed to help you tap into high-growth companies, but they take slightly different paths to get there. QQQ gives you concentrated exposure to the tech-heavy NASDAQ 100, while VUG focuses on large-cap U.S. growth stocks across a broader range of sectors. Let's start with one of the most popular growth ETFs out there, QQQ. As of September 2024, the Invesco QQQ Trust manages a massive $288.54 billion in net assets, making it one of the largest ETFs on the market. At a market price of $473 per share, QQQ gives you access to the NASDAQ 100, which is packed with some of the most innovative and fastest-growing companies in the world. QQQ is heavily focused on tech, with Apple, 8.92%, Microsoft, 8.36%, and Nvidia, 7.66%, leading the charge. But it's not just about tech. QQQ also has exposure to companies like Amazon, 5.07%, Meta, 4.78%, and Tesla, 2.91%, making it a tech-heavy fund with some diversification in consumer services and retail giants like Costco. These top 10 holdings alone make up a big chunk of the fund's total assets, giving you direct access to the key players driving growth and innovation in the U.S. market. In terms of performance, QQQ has been impressive. So far in 2024, it's delivered a year-to-date return of 17.33%, and over the past year, it's seen a 30.59% return. The longer-term numbers are even more exciting. 11.28% over the past 3 years, an average of 21.52% annually over the past 5 years, and a strong 18.65% over the past decade. This shows QQQ has consistently delivered solid growth, especially during tech booms. Even though QQQ is primarily focused on growth, it still offers a small dividend with a dividend yield of 0.61%, paying $2.89 per share in the past year. But make no mistake, the real appeal of QQQ is the growth potential of its tech and innovation-driven companies. With an expense ratio of 0.20%, you're paying a bit more in fees compared to some other ETFs, but that cost can be worth it when you're investing in some of the most dynamic companies in the market. Let's imagine you're investing $100,000 today in QQQ. Your $100K investment would grow to approximately $262,738 after 5 years, with its strong 21.52% average annual return. During this period, you'd also earn about $3,050 in dividends, thanks to QQQ's 0.61% dividend yield, boosting your overall returns. After 10 years, your investment would climb to an impressive $554,357. Over these 10 years, your total dividends would accumulate to around $6,750, all reinvested to maximize growth. Looking at the 20-year mark, your $100,000 investment in QQQ could soar to $3,074,324. with dividends adding about $18,550 to your portfolio. And finally, after 30 years, your initial $100,000 could grow into a jaw-dropping $17,046,462. Over this time, you'd have earned approximately $49,500 in dividends, further compounding your wealth. Now let's dive into VUG, the Vanguard Growth ETF, another powerhouse for growth investors. As of September 2024, VUG holds an impressive $136.475 billion in net assets, making it one of the most popular growth ETFs on the market. Priced at $374 per share, VUG gives you exposure to a wide range of large-cap growth stocks. But what really makes this ETF stand out is its expense ratio of just 0.04%, significantly lower than the industry average of 0.94%. That means if you invest $10,000 in VUG, you'll only pay $4 a year in fees, making it a cost-effective choice for long-term investors. VUG's top 10 holdings include some of the most innovative companies in the world, with Apple, 12.90%, Microsoft, 12.40%, and Nvidia, 10.91%, leading the charge. But unlike QQQ, VUG offers a bit more diversification with holdings in Amazon, 4.88%, Meta, 4.16%, and Alphabet, 4.02%, alongside other high-growth companies like Eli Lilly, Tesla, and Visa. This broader range of industries means VUG isn't as tech-heavy as QQQ, but still delivers high-growth potential across different sectors. When it comes to performance, VUG has delivered strong returns with a year-to-date return of 21.14% and a one-year return of 31.92%. Over the past 5 years, it has averaged 18.50% annually, and its 10-year average annual return is 15.06%, making it a reliable option for long-term growth. While VUG is primarily a growth-focused ETF, it does provide a dividend yield of 0.51%, giving you a bit of income along the way. So, if you're looking for a fund that gives you exposure to high-growth companies across a range of industries, all while keeping costs extremely low, VUG is definitely worth considering. It's the perfect blend of innovation, growth, and low fees, making it a top choice for long-term investors. Let's imagine you're investing $100,000 today in VUG. Your $100K investment would grow to $235,984 after 5 years at an 18.50% annual return. In addition, you'd earn about $2,550 in dividends from VUG's 0.51% dividend yield, which would further fuel your investment. At the 10-year mark, your VUG investment would expand to $405,066, with a total of $5,100 in dividends reinvested over the decade. After 20 years, your portfolio could reach $1,641,072, with dividends contributing about $13,550 to your returns. And after 30 years, your initial $100,000 investment in VUG would grow to $6,647,889. During this time, you'd have earned approximately $33,000 in dividends, all reinvested to enhance your long-term gains. Now that we've explored both QQQ and VUG, let's compare them directly. QQQ focuses exclusively on the NASDAQ 100, giving you concentrated exposure to some of the largest tech giants like Apple, Microsoft, and Nvidia. This makes it a highly tech-focused ETF, which can result in higher returns during tech booms, but also higher volatility. In contrast, VUG offers broader exposure to large-cap U.S. growth stocks, not just in tech, but also in sectors like healthcare and finance, with holdings such as Eli Lilly and Visa. This makes VUG more diversified across industries, providing more balance and slightly less volatility compared to QQQ. When it comes to expense ratios, VUG has the clear advantage with a low 0.04% compared to QQQ's 0.20%. This difference can add up over time, especially for long-term investors, making VUG a more cost-effective choice. Performance-wise, both ETFs have strong track records, with QQQ posting a 30.59% one-year return and VUG close behind at 31.92%. Over the long term, QQQ has a higher 5-year average annual return of 21.52%, compared to VUG's 18.50%. reflecting QQQ's strong performance during tech-driven market rallies. However, VUG offers more diversification, which may appeal to investors looking for growth without the higher risk of a tech-heavy portfolio. In the battle between QQQ and VUG, both ETFs offer serious growth potential, but the choice comes down to your strategy. QQQ delivers higher returns with its tech-heavy focus, while VUG offers broader diversification across multiple sectors with lower fees. If you're all in on tech innovation, QQQ might be the way to go. But if you want a balanced approach to growth, VUG could be your best bet. Let me know in the comments which ETF you're leaning toward, and don't forget to subscribe for more ETF comparisons and investing insights.